Welcome back. Our next guest says the value rotation has plenty of room to run and thinks emerging markets are in for another strong year of performance. So let's welcome Jordan Jackson, global market strategist at JP Morgan Asset Management. It's good to have you join us. Thanks so much.
Thanks so much for having me.
So what we've been seeing so far this year is kind of like a shift from growth stocks over to value stocks. Do you expect that trend to continue throughout the year?
We do think that this is very much a sustainable trend, and arguably this rotation really began in November of last year. The tech sector last peaked out on October 29th, and so when you just look at that 4-month period, values actually outperformed growth, looking at the Russell 1000 value and the Russell 1000 growth indices by 18 percentage points. If you go back to 2000, that is the top 2% of rolling 4-year windows where we've seen this type of outperformance. And a lot of it is a bit of AI fatigue. We know valuations were getting a bit stretched across the AI and the large cap growth trade. When you think about interest rates, our view for the Fed is that the Fed's probably going to cut rates 1 to 2 times. So you think about the cost of capital, it's still quite high, and that disproportionately impacts more expensive growth stocks whose cash flows are far out into the future. And then lastly, you've actually seen some pretty genuinely improving earnings backdrop for value-related companies. So analysts expect about 10.5% earnings growth coming from value this year. This is up from just about 1.5% earnings growth back in 2024. So there is a pretty an improving backdrop, and we very much believe that this rotation has some legs to it.
Interesting. With that in mind, then, where does that leave technology stocks? Like, are we not going to see a rebound? I imagine a lot of investors are still holding a lot of technology stocks. Or are we just going to see them kind of continue on the trend they're already on?
It's been really interesting. It seems like the market is sell first, ask questions later, right? So, I think there could very well still be a little bit more pain. It's noteworthy that when you look at, obviously a very big player in our index, the largest company in the world, just reported another fantastic round of results, yet you're not necessarily seeing the stock price rally quite meaningfully off of the back of that. So, I think, again, there's just a lot of this AI fatigue. And the problem is, particularly with a market cap index like the S&P 500, if these big names in the index necessarily don't perform well, it's sort of hard to have the index perform well at the surface level, just given that concentration risk. So, look, we're not dumping these companies altogether. They're strong balance sheets. They've got the cash flow. They're spending, actually increasing their capex really across the board. But we do recognize that the market is growing a bit weary and is looking for some proof in the pudding across tech.
No kidding. Okay, so we talked about that recent value rotation that we're seeing to, as you say, beginning in the fall of last year, continuing into 2026. How do you see that benefiting sectors in Canada this year in certain economies, like, for example, materials, energy, in certain sectors like that?
It is incredibly important. Obviously, the Canadian market being a very value-orientated market, you're getting a lot of financials, materials companies. The slope of the curve, right, is steeper out in Canada relative to the U.S. So you've got that net interest margin profitability coming through. Some of the challenges, though, of course, is the consumer and sort of the pace of overall economic activity. We do anticipate that U.S. growth could run a bit stronger than that of Canadian growth. And so as you think about consumer activity and lending activity and credit growth and credit creation, that could be a little bit of a headwind towards financials more broadly. But that being said, right, when we think about this new AI build out, this AI landscape, it is the energy companies that are going to be powering the data centers. It's the industrial companies that are going to be laying down the fiber optic cables. It's the material companies that are going to be providing the hardware inputs to all this build out. So again, we think this is a kind of a multi-year sort of trade. And what's quite interesting, or sort of the tagline that I've been running with is this growth spending is translating into value revenues. We're seeing that in the numbers.
Okay, so I want to talk about emerging markets, obviously, because that's part of this conversation. You think emerging markets poised for yet another strong year? Are there any interesting trends that you see happening as we head further into 2026?
Absolutely. So when we look at, and I like to break down the contributors to returns, so whether that be dividends, earnings, valuations, so multiples expanding. When you look at emerging market returns, this was a big story last year. Most of the returns were coming from earnings growth. This year, all of the roughly 15% return that we've seen on the MSCI Emerging Market Index is coming from earnings. And there's a number of different sort of regional aspects here. When you look at Asia, for an example, they're benefiting from this broader build out as being the primary providers of many of the chips and semiconductor inputs. Periphery Europe, for an example, is benefiting from perhaps the consumer coming back online, the technology wave as well. Also, sort of luxury goods and brands, that part of the market does appear to have some further upside from here. And then specifically with Latin America, while the earnings necessarily hasn't been quite as strong, the backdrop remains constructive, with this broader resource grab, energy grab, more broadly on a global scale. We're not calling for a commodity super cycle per se, but we do think that commodity prices could move higher. And the second derivative of that are going to be commodity exporters, which many of them are in Latin America. So, the backdrop remains pretty supportive for emerging markets, and investors are voting, are following that with dollars, and that's why we're seeing continued strong performance out of that area of the market.
So interesting. Okay, we will have to leave it there, but really appreciate your time and your insight. Thanks for joining us today.
Thank you.
That's Jordan Jackson, Global Market Strategist at JP Morgan Asset Management.